Okay, welcome back. Raunak Onkar is now with us, co-fund manager of equity and head of research at PPFAS Mutual Fund. Raunak, great to have you with us here on the program. Thank you, as always, for being with us. Let's just start with the two capital market names in your flexi-cap fund that are very visible. One is, of course, Motilal Oswal. The other is MCX. And I ask you this in the context of this entire NSE-BSE debate. It was our story yesterday, which we said that both exchanges want Tuesday as the expiry day, and then of course we'll see what happens. Just your, BSE is the only listed stock exchange. You own MCX. Is it just about sort of owning the dominant kind of player in the space? What are your thoughts? I mean, why not have BSE in your portfolio as well? Not now, it's already done phenomenally well, but just trying to understand the thought process.
Prashant, thank you for inviting me. Good to see you. It's a nice question. So the whole idea is, if you look at any of these capital market intermediaries, they are essentially network effect plays. So you need more buyers, more sellers transacting on these platforms, and that generates the economic value for this business. And from the capital requirement point of view, all these companies are very capital light, except for the regulatory capital that they need to hold. And any of the new services that they sell, like data feeds or anything, are essentially incremental profits for them, because the data anyway is their own proprietary data. So because of this model becomes very attractive, and going with a dominant player usually helps, because the network effects can be quite strong and very difficult to penetrate. Although we have seen in the past that when NSE was not there, BSE was very dominant. But once NSE came, BSE's dominance a little bit waned in the core activity of stock trading. So it's not guaranteed that any platform will retain its dominance. But once you are at a critical mass, these platforms tend to be very sticky, and transactions and volumes tend to converge to the more dominant player. So that's why dominant players with higher market share are preferred.
All right, got that point. Raunak, hi, great to have you this afternoon. Before we talk more, themes and sectors and what you like and how the portfolio's moved, I have to talk to you about the cash levels. Now, between money market instruments, cash, arbitrage, you're holding 26% cash in the portfolio. I think it's the highest we've seen, across the industry in a very long time. Definitely, I think in my reporting career. And what's the sense here? And we've had a correction, but yet your cash has been high. Is valuation still a problem? And at some point, isn't that going to become a bit of an issue with investors if the market keeps rallying?
So maybe in the history of PPFAS, this is not the highest cash position we have had. So we have had about close to 30% cash holding of the AUM when we were in the 2018-2017 bull market, when the same situation occurred, that wherever we wanted to look or take a position, the valuations were not too attractive. And even today, just even after the Q4 results are out, many of the sectors where growth has been very, very promising and growth has been beyond expectations, the valuations of those sectors are actually significantly above the median valuations they were quoting. Now, one can assume that these valuations can continue to go up and up, but that's not how equity market or cycles work, right? So if cycle turns against these companies, then the valuations can derate very, very quickly. So it's better to be cautious when you're looking at a market which is generally a little overvalued. And in India, if you're seeing most of the sectors where the businesses are very stable and the growth rates are quite moderate and in their long-term averages, the valuations have not corrected as much. Where the valuations have corrected significantly is where the cyclical tailwinds of that particular company or a sector have disappeared for a short period of time. And that's what cyclicality does. So the valuations might look on a normalized basis very, very expensive, but on a short-term basis or a trailing 12-month basis, they might look reasonable. So we are not seeing valuations at an attractive position right now. Hence, the cash has been there. So it's a bottom-up call. It's not a call based on the market has to fall or correct and we'll deploy. And we have been deploying. So if you see the last month's fact sheet and this month's fact sheet, a lot of the existing names is where we have added our positions. And more or less the weightages across sectors also remain the same.
Raunak, hi, you've exited ITC Hotels. Is that correct? That's the recent change?
That's the only recent exit we have done. We got it in the demerger from ITC Limited. We still continue to own ITC. But ITC Hotels is something where we see the valuations and the growth rates are not very, very reasonable at the moment. So we will reevaluate. So we are tracking this sector very closely. We are aware of this business model. But at the moment, the valuations are not attractive.
Hi Raunak, good afternoon, good to see you again. Raunak, I'm looking at the same set of stocks that you have, Coal India, Power Grid, Petronet, LNG. Coal India, what's the view over there? Because, it had valuation support, but now the fear is that they could start seeing degrowth in volumes. What's your view on the stock? Valuation comfort, yes, but if they start seeing degrowth, then that's a worry, right? Captive coal mines are ramping up.
So that is again a thing we have to wait and watch, because any of the mining capacity coming up does take time, and by the sheer volume of which Coal India operates, to suddenly dislodge the supply chain is also very, very difficult. So at the moment, the ramping up of volumes itself for Coal India is happening. Production mechanization has been happening for a while. Their productivity improvement also has to be seen how it goes over a period of time. So I think over a period of time, the thermal piece of power that we use as a base field for the domestic power consumption in India, that I don't think is at a threat. In the longer term, yes, renewable sources will definitely try and edge into it. But as the power needs keep going up, as more manufacturing capacity India wants to put up, more households are also being built. At the same time, we want EV penetration. We want all the modern facilities that all developed countries also enjoy. So all of these needs power. So power demand itself is on a growth trend. So it remains to be seen where the volumes actually will grow. But short term, anything can happen. But longer term, I think it's not there yet where we can completely phase out coal power and say now we can depend fully on renewables.
No, absolutely got that. Just a quick word on your US tech exposure, Raunak. That's remained static, right?
That's remained static. We own 4 of them. So if you remember, RBI has not allowed mutual funds to invest globally after 2022. Since then, the overall allocation of the US stocks in the portfolio has also come down for us. Most of the incremental flows have been into Indian stocks only. And we have the 4 stocks. We own Microsoft, we own Alphabet, which is the parent company of Google. We own Amazon, and we own Meta, which owns Facebook, Instagram, WhatsApp. So all of these companies are on a very, very different growth trajectories of their core business as well as the cloud business and the social media and digital advertising business. These are actually long-term tailwinds, and it's actually most of the time it's surprising to see at the scale at which they operate, they continue to grow at these growth rates and with the return on capital that they generate despite spending so much money on the GPUs and computing capex.
And did the team at PPFAS have a discussion about? I mean, the only thing you can do is reduce exposure here to these 4 names. You can't add. They went through a bit of a drawdown phase earlier this year. Was there any discussion at all to trim position before that or during that period? At all, no.
In the drawdown, it's actually better to add on to these stocks, but unfortunately, we can't add at the moment. But whenever we earn dividends from these companies, we do reinvest in them. And anyway, we are free to reshuffle this portfolio. So if we feel like selling one of them and buying something else in the international markets, we are free to do that. But at the moment, the tailwinds I spoke about, all these companies are running on, they are very, very strong for them. And the nearest competitors are not there yet in terms of scaling and also building the distribution advantage that these companies have. So it remains to be seen whether the dominance of these companies is waning. But yeah, cyclical or valuation fluctuations are fine. We can tolerate them.
This news on Google, Alphabet, which you own, that the number of searches is down for the first time, I think, in 15, 20 years or something, right? That was the last data point because of things like perplexity, things like all these large language models, etc. Does that worry you at all at the margin?
So in fact, it's a good thing and a bad thing. Bad thing because the company is reducing its search volumes. But again, it's a platform change as well, how people are consuming search as a product now. And it's actually a good thing because if you see, Google has been in the crosshairs of antitrust for a very long period of time. And because of that, if a new competitor can take some volume of search from a major player, actually a good sign that competition is still thriving. And it remains to be seen what happens to the case that they are fighting in the department with the DOJ in the US. But it's interesting to see that competition is still thriving and Google has to pull up its socks and improve its product if it wants its search results to go up.
Out of time. Raunak, thank you very much for joining in. Enjoy your weekend. So that's the word coming in from